this live? Okay. Well, you can see I feel a personal responsibility for having Ed here, because I said to Ken that the complexity of these issues, and they're very important actually for the economic impact, was such that we really needed somebody who understood the substance of this tax bill. And I was joking before this session that we're all sort of Senate staffers at one time and another, and I was hired by the Senate Budget Committee from New York as an economist to follow the tax portfolio. And after they made me the offer, I said, look, just in terms of honesty and advertising, does it bother you that I don't know anything about tax policy? To which my then boss said, you'll learn. And I learned enough to be dangerous, but the complexity that is in this bill is really stunning, quite unique. So, I just will make 4 kind of major broad points. I'm an unabashed fan of this bill. I think it is really transformative for the American economy. And with that said, most of you are concerned about multinationals. And the reason I think this is transformative is because the domestic firms benefit without offsets. The multinationals benefit far less. And in addition to some tax rate differentials I'll mention, many of these, what I'll call tripwires, I figured that wasn't an exactly satisfactory description, so we needed to have some detail here. But there are a lot of tripwires for multinational firms that diminish the value of this bill. Now, with this said, I actually think that this is one of the most important policies that we could adopt to improve trade tensions in the world, and I'll make some points around that. And then finally, there's no instant gratification here. I was astonished that the stock market seemed, once the bill was passed, to sort of run up, being willing to capitalize what is, as you can see from this complexity, a very, at a very high rate, the promise that this tax bill brings, but the promise is really administered, so to speak, through the incentive structures, and it's not the absolute dollars that are transferred from the public sector to the private sector. And it's going to take not just months, but years for these incentive structures to sort of work themselves out and actually result in location and investment decisions that might alter, and I think to a really very modest degree, the kind of investment geographic footprint that we see for U.S. companies, multinationals overseas. So let me just add a few details. First, the benefits of this bill. The previous tax law was highly progressive. The corporate tax was much more progressive than the individual tax, and it's one of the reasons that we've seen this shift from the corporate form to the pass-through form in terms of businesses. But with that said, it's important to remember there are 34 million businesses, 32 million pass-throughs, about 1.6 million corporations in America that will benefit from these tax reductions. And as such, you're really moving from a 40% tax rate and on a state and local basis for an awful lot of corporations, because it's very important to realize that all corporations are not Apple, all right? About 75% or more of U.S. corporations have $2 million in revenue or less. Corporations. Now, pass-throughs are even smaller. So this bill allows them to have a line of sight to a much lower tax rate, allows them to be able to play more flexibly in the marketplace, to be able to liberalize the constraints that they felt in terms of cash flow and the like. And it also creates a parity between what I would call active business engagement and capital, let's just call it capital realization, sort of with the financial firms, because you've got roughly a 20 to 20 some odd percent tax rate on business income, ongoing business income, and a similar tax rate on capital gains. Now, with this said, I think Ed did a great job in illustrating why there are these differential benefits between domestic firms, which benefit from the tax rate cut and expensing, but don't have this very complex set of tripwires that actually raise their effective tax rate in many cases. There is this cost to territoriality, and many companies, the technology and the pharma companies, have tax rates, effective tax rates, that are below 20%, that are in the teens, and many, and most, these are sort of unique, most other sectors multinationals have tax rates that are in the high 20s. So yes, they get the 21% tax rate, but then they have all of these other payments and the deemed repatriation and an ongoing minimum payment, as you describe it, on their international operations. So when you talk to business leaders in these companies, they're kind of like, they have more flexibility in terms of how they use their cash. A lot of them have, both foreign and domestic, have large U.S. shareholder bases. This enables them to pay dividends to shareholders, from the cash, irrespective of where it is incurred. It'll probably add liquidity to the U.S. M&A market. But as a major factor in their decision making, I think this bill is going to be much more marginal. Now, I said this, I thought that this was very important for reducing trade tensions and some of the trade tensions that you see in the Trump administration. And why is that? Well, it is, it is my observation, and I think I could prove it quantitatively, that the world has really shifted from the old comparative advantage model of trade that maybe I'm looking around the room here, and maybe I'm dating myself, that some of us learned in our international trade classes, to one where we really have a supply chain based global footprint for an awful lot of companies. And I have in my past done surveys on what some of the relative factors are that result in location decisions, and markets are overwhelmingly the most important factor. So what has happened over the years, the U.S. is the largest market in the world, by the way, China is the second largest market in the world, is that the U.S. has become a terminal market. But for all of these reasons that Ed described, that represented these relatively high tax rates, which I view as a surtax on U.S. investment, the U.S. didn't participate in the full supply chain, which is one of the reasons that you've seen the decline in manufacturing in the U.S. Over the last 10 or 15 years. I think this does a lot to take tax out of the location decision and to encourage, because the U.S. is very cost competitive, we've got very low energy costs, to encourage companies to invest in the U.S. to fill out that supply chain. But I think that that's really something that's going to occur, over a number of years. So, I just make a couple technical points and then I'll pass it on to my fellow panelists. This tax bill, when I talk about the tax bill operating through the incentive structure, the tax bill, although Ed makes it very clear, has a number of technical flaws in it, such that many companies don't know really how some of the provisions are going to be administered from a tax point of view. The SEC has actually provided a broad window to allow companies a kind of a grace period in terms of this year to be able to reserve against the uncertainty associated with these tax changes. So, we're not going to see these changes take place in any kind of immediate form. And to those in the audience, I think actually that we're seeing the beginning of what is going to be the end of tax arbitrage as countries begin to converge around tax rates that are in, let's just say, the low 20s. So that, and when one looks at how companies evaluate their location decisions, the second most important element is quality of the labor force and rule of law. I think that you'll see these become relatively the competitive factors that will determine location decisions versus the tax arbitrage that we've seen in the past. So for those who might be economic historians in the crowd, I consider this to be a triumph of Hayek over Keynes, because Hayek really talked about investment as being related to the incentive structures rather than these absolute dollar transfers. And I think that we'll actually see more manufacturing move to the U.S., more jobs, less tension around international trade, and I think that this convergence among tax rates among countries is going to be a very important factor in determining that outcome. So thank you, Ed.
Thank you, Gail. What I want to do is start by observing that there's an underlying philosophical, economic, legal argument in these international tax matters. On one side, you have people that believe in this theory, capital export neutrality, think of that as worldwide taxation, think of that as tax harmonization. And on the other side are people who believe in capital import neutrality, and that would be more the camp of territorial taxation, and those of us like me who see tax competition as a useful check on governments overtaxing and overspending. And so that's actually a theory that doesn't get enough attention because I think it does undergird a lot of the fights that we see on these issues around the world. In terms of the tax bill, let me make a couple of observations that I think are probably worthwhile. One thing I've noticed just in terms of speaking overseas a couple of times since this whole process got started, both before and after the tax bill was signed, is a lot of people think, oh, this was a giant tax cut. It's a tax cut for the first 9 years. In year 10 and after, it's actually a slight revenue increase. So there's nothing really in this bill that I think that you would characterize as dramatically reducing the aggregate tax burden in the United States. Yes, the corporate tax rate comes down, but there are other offsetting revenue increases, especially once you get into the out years. Basically, we pay for a lower corporate tax rate by restricting the state and local tax deduction and making a few other changes. But this is not a giant tax cut, and a lot of people are confused on that matter. And on the issue of worldwide versus territorial taxation, Ed and I were just joking about this before we got up on the stage here. We were not a pure worldwide system before the tax bill, and we were not a pure territorial. As you listen to all Ed's exceptions, we're obviously not a pure territorial system. In my mind, I sort of put it in the category of, well, we were 60% worldwide before this bill, and now we're 40% worldwide. And that's, of course, just a very rough back of the envelope, but it would be something like that, I think, in terms of the actual practical effect, because we did have this worldwide system, but the deferral law that Ed mentioned, basically it was a do-it-yourself territoriality to some degree. And now it's officially territorial, but now there's sort of the government do-it-for-you worldwide provisions in it. So we've made the law a little bit better from my perspective on the worldwide versus territorial issue, but it's not as big and dramatic a change as a lot of people seem to think it is. And by the way, I'll confess something here. A lot of the people pushing for territorial taxation kept talking about this $2.6 trillion that was locked out of the country. It wasn't really locked out of the country because global capital markets are very fluid. So if U.S. companies were artificially holding some money overseas, that was made up for by foreign money that was coming into the U.S. because guess what? On a global level, after-tax rates of return tend to equalize, and so I don't think the U.S. was actually suffering a great capital shortage because of that provision. I thought the provision was bad. I don't think the government should be taxing money that was already earned and subject to tax in another jurisdiction, but people on my side, I think, exaggerated a little bit about, oh, we're going to see this giant flood of money coming back to the United States. Some of it may come back, but it'll probably displace foreign money that was coming in already in the first place. And speaking of foreign money coming in, another thing that a lot of people don't seem to realize about the tax system and about global investment flows is that the direct investment of multinationals is actually relatively small compared to the indirect or passive investment flows. You were at Commerce, weren't you, Rob?
Yeah.
You know, you look at the Commerce Department every year puts out something called, what, International Investment at Year End? And if you look at that document, you know, very fascinating if you're an economics dork, but you look at that document and you can see that the passive investment, the foreigners buying stocks and bonds and things like that, or just setting up a bank accounts in the U.S., that's something like, what, a 4-to-1 margin, $4 of that for every dollar of direct investment, at least if I recall correctly. So the indirect investment flows were always huge, and those indirect investment flows obviously can change much more rapidly than direct investment flows. And we always, by the way, got a lot of that indirect investment because our tax rules for inward passive investment were always very favorable for foreigners, and that hasn't really changed. Actually, I don't think it changed at all in any significant way.
Well, beat tax will change.
Okay. But anyhow, so when you're keeping in mind, we're supposed to be talking about the trade and investment implications of this thing. Some stuff got exaggerated, some stuff got overlooked. I agree with Gail that the bill was good, lowering the corporate tax rate was good, but I also agree with her that it's not as good for multinationals. And I don't get deep into the weeds like Ed does simply because I don't have any reason to. I mean, the amount of times reporters have called me asking about these detailed things I can count on one hand, whereas the amount of times I get called about the big picture fiscal policy fights is countless. But the first thing I did when the Joint Committee on Taxation put out their score, their revenue estimates of the bill, is I looked at, okay, there's the number for territorial taxation, the tax cut, but then I looked at all these provisions Ed was talking about and the revenue gains associated with them, and it wasn't a wash, but the numbers weren't that different. So I realized multinationals, whatever the government is giving them with the right hand, to some degree it's taking away with the left hand. Now, of course, I don't necessarily think that the joint tax estimates that are made today will reflect the world we're in tomorrow, because corporate behavior tends to change more in response to changes in tax law that I think sometimes joint tax recognizes. But the mere fact that on paper the revenue increases from the international provisions were significant, I thought that meant that the territoriality shift was somewhat overblown in terms of people's perceptions of it. What I want to do, though, is focus on the issue that I think is the most important in this, which is the role of tax competition. I'm from sort of the public choice school of thought from George Mason University. That's where I got my training. And the public choice school of thought has what's called the Leviathan theory of government, which is the theory that governments will overtax and overspend unless there's some sort of external constraint binding their behavior. I sometimes call this the goldfish theory of government, because when I was a kid, we were always warned if you got a pet goldfish, don't feed it too much because it will literally eat itself to death. Now, I don't know whether goldfish actually eat themselves to death, but I think this does apply to some degree to the behavior of governments, where especially you see in some of the welfare states in Europe, they've taxed and spent themselves to a point where I think their economies are in very, very shaky, precarious, long-run shape. And when I look at the world today, and I look at the demographic changes, and think about it this way. We all learned about population pyramids when we were in school, that traditionally you only had a few old people, and then a big generation of workers and an even bigger generation of children under them. Well, what's happening over time is we're living longer, whichever year older I get. I think that's a good idea, but we're also having fewer children. So those population pyramids are becoming population cylinders. Now, when you had population pyramids, a modest-sized welfare state was mathematically quite feasible. As a grouchy libertarian, I didn't like it, I would argue against it, but it could work. The problem is, as we move from this population pyramid to a population cylinder, even modest-sized welfare states are going to come under a lot of pressure. And that means that that natural tendency under the Leviathan theory of governments to overtax and overspend, I think is going to become more pronounced. And I think we see this in terms of all these, a lot of the fights that we're seeing in terms of corporate taxation, in terms of BEPS, it's simply ways of governments trying to figure out how can we take a bigger slice of the income of the business community and transfer it to ourselves. And of course, they're under political pressure because they've been jacking up consumption taxes because that tax base isn't very mobile. They've been jacking up the taxes on basic labor income because that tax base is not relatively mobile. But what tax base is mobile? Corporate income. And to some degree, the tax rates on high net worth individuals because they can move a lot more easily than an ordinary person can move. So what's happening is at the same time governments are trying to figure out, given these demographic changes, we need to grab more money from the private sector, they're also facing this globalization-induced pressure where labor and capital can cross borders more easily. I think that globalization-induced pressure is very good because I don't want that goldfish government to tax and spend itself to death. And right now, that tension is playing out in the field of international taxation. It's the whole reason why the OECD is pushing its anti-tax competition efforts. It's the whole reason why the European Commission is pushing various anti-tax competition initiatives. My view is that those initiatives are bad, that if we want to try to force governments to adopt more sensible policy, they need to be acutely aware of the fact that if they raise taxes, they're going to lose jobs and investment to other countries. And that's why I think the 21% rate, I mean, the U.S. is still above average, not just on the world basis, even on an OECD basis, our corporate tax rate, including the state and local corporate tax, we're still above average. But coming down by 14 percentage points, I think is going to be very, very significant. And I would be very surprised if 1 or 2 years from now that we have not seen other countries lowering their corporate tax rates in response. You go all the way back to 1980. I think Greg Mankiw calculated that the average corporate tax rate in OECD nations was 48%. Prior to the U.S. corporate tax rate reduction, the worldwide average was down to 24%. I don't think that happened because people were reading the policy papers I write. I don't think it was because people were reading Milton Friedman or Friedrich Hayek. I think those corporate rates came down for the same reason the individual rates came down. When Reagan and Thatcher got the ball rolling on tax cutting, when Ireland and Switzerland reduced their corporate rates, it basically forced other countries to do the same thing. And I very much hope that this corporate tax rate reduction in the United States triggers a new round of tax cutting around the world, precisely because I want to make governments feel the pressure so that they'll reform the spending programs rather than go down this goldfish path of taxing and spending their economies to death. Rob?
Well, I'm going to set aside politics.